Good day, fellow investors. Google released earnings and the stock is down 7%. What we need to understand is the risk and reward. I have been discussing Google in my value investing quadrant and shifting it from more exuberance to less exuberance, and here I have put it a little bit riskier than the market for still a good return of likely around 10%. The stock is down yesterday on earnings, but if you adjust for a month or a few weeks, then it's just flat. So over the longer term, Google did great over the last 5 years, outperforming the market. But let's look at the risk and reward and the huge AI cloud investments that scared the market likely yesterday. And if we look at the numbers look great. Revenues 12% growth, net income increased 28%, 31% earnings per share income. Thanks to the buybacks, everything looks good. Even cloud and YouTube exited at an annual revenue run rate of 110 billion. So the diversification is away from just search. And the key is that we expect to invest approximately 75 billion in capital expenditures in 2025. 75 billion is increasing significantly the capital expenditures, and the question is, what will the return be there? For now, everything looks great in the numbers, in the returns, in the net income, growing and reaching 100 billion for 2024. If we look at more specific things, YouTube is still growing, search is also growing, still very strong. Of course, cloud is growing, and if you look at other bets and things like that, that can be slowly forgotten, but you never know. The key is that things are growing and looking very positively for Google. If we look at where the share of the income comes from, it's still just Google services. Google Cloud is already turning profitable and increasing the profitability. Other bets are simply losing money. But if we look at the conference call, you see that AI infrastructure is the key. The research, the modeling, the tooling, and all of that requires investments. So they will keep on investing even more than the 14 billion they invested in the last quarter. All in all, 70 billion returns to shareholders, minus 20 billion of stock compensation. So the real return to shareholders is 50 billion. Let's not forget that. And they are going to invest in technical infrastructure, servers, followed by data centers and networking, and pushing those investments higher, which is the key worry, because you will see higher pressures on profit and loss, because you will see higher depreciation over time because of those higher investments. Already in 2024, Google saw 28% growth in depreciation, and then the key is how long will that growth just continue on? If we look at the cash flow statement, you have here 23 billion of stock-based compensation expense. That is then adding to the cash flows, but you will see in the next slide, before we touch here, 50 billion of Capex now going to 75, and you will see now how they are also repurchasing stock. But if they are issuing 23 billion in stocks and repurchasing 60, that's a 40 billion repurchase, and dividend payments are just 7 billion. So all in all, I would say that Google is doing great. If things continue to grow at 10+%, so will the stock, especially because the PE ratio is 25. The key question is now, AI, what will the returns be on these huge investments? Will everything keep on flowing with the 10%, 15% growth, or we might see a decline, a digital commerce recession that we haven't seen in a while? So that's also something, a global recession. And then also, let me know in the comments, what kind of ad did you get before watching this video or during this video? Because if the ads are exuberant, like really chasing any kind of liquidity out there, that market often freezes in an economic downturn. So that's also something that nobody is talking about, but I always like to see the risks and then compare them to the possible rewards. If we look at the questions from analysts, so trying to model and get a return on that, AI also asking about the competition and DeepSeek impact and the news coming from China, what is going on there. So they say that their models are great, but I think that here is the key when it comes to investing in Google. Competition. Google search, we can say they didn't have much competition in delivering, and they are therefore now very profitable and doing great. However, AI, there is global competition, there are global players, and therefore we don't yet know what the return will be on that investment. That is a risk. So when it comes to putting Google on my risk and reward quadrant, the first factor is price. Okay, P ratio 25. From a value investing perspective, for such a growth stock, it would be better at 20, and then Google would be already here higher. The growth, we are now growing at mid-teens, but it can also be 8% over the cycle. Doesn't mean that Google will forever grow that fast. So if I just take a more conservative growth, maybe a recession here and there, so let's say the growth here at 8-9%, I am close to a 10% return because of the risks of competition. But don't worry, if Google just keeps on investing, and as they say for their cloud, and there is simply not enough capacity that they can put on in time for the demand, and the growth keeps on 10%, 12%, the stock will follow on a P ratio of 25. Maybe it go to 20, sometimes it will go to 30. So all else equal, Google will likely deliver a good return going forward. But there are always these risks that we never know when could they materialize, and especially in this Goldilocks economy and market that we are seeing now, that we'll discuss more in a few days. It sounds crazy to just talk about risks, but we are here for that. Thanks for watching. I'll see you in the next video.